92% of professional fund managers fail to beat the market over 15 years. Most active investors are fighting a statistical gravity that eventually destroys their relative wealth. The Vanguard S&P 500 exchange-traded fund charges 0.03% annually. Many active funds charge over 1%. That gap creates a massive wealth divide. Over 30 years, a 1% fee can consume 1/3 of your total portfolio value. Paying for performance you rarely receive is the most expensive mistake an investor can make. Active managers trade frequently, which generates massive transaction costs and bid-ask spreads. These hidden leaks drain capital before you even see the official return numbers on your statement. Exchange-traded funds use an in-kind creation and redemption process. This avoids triggering capital gains taxes that plague traditional mutual funds. You keep more money working for you every year. Bad active funds are simply closed or merged into better ones to hide poor records. The average return of surviving funds looks better than the reality of the entire industry performance. VOO uses market capitalization weighting. This means it automatically increases exposure to companies that are winning and reduces exposure to those that are shrinking. It is self-cleaning. With one share, you own 500 of the largest American companies. This eliminates the idiosyncratic risk of a single company bankruptcy ruining your entire retirement plan through diversification. Human investors panic sell during downturns and overbuy during bubbles. An index fund removes the need for decision-making during periods of high market stress and emotional volatility. Missing just the 10 best days in the market over a decade can cut your total returns in half. Staying fully invested beats trying to time the perfect entry and exit. Active funds pay for research teams and expensive offices. These overhead costs are passed to you. VOO is run by an algorithm with minimal human intervention and lower costs. Dividends account for a significant portion of total long-term returns. VOO automatically captures these payments from 500 companies and allows for seamless reinvestment into more shares.
Short-term active outperformance is often due to luck rather than skill. Over decades, mean reversion forces most managers back below the index as their lucky streaks eventually run out. Before fees, the average investor is the market. After fees, the average active investor must underperform the market. It is a mathematical certainty that passive investing wins on average. Modern markets reflect new information almost instantly. Trying to find undervalued stocks is harder than ever because thousands of algorithms are competing to find the same tiny price discrepancies. Active managers often guess wrong on which sectors will lead. VOO holds them all in proportion to their actual market value, ensuring you always own the current market leaders. Warren Buffett bet $1 million that an S&P 500 index fund would beat a collection of hedge funds over 10 years. The index fund won convincingly. The companies in VOO are the bedrock of the global economy. They have the massive balance sheets and cash flows required to survive economic downturns that bankrupt smaller firms.
Financial advisors often sell complexity because they can charge higher fees for it. Complexity does not equal higher returns. In investing, the simplest path is usually the most profitable one. Low turnover means fewer taxable events and lower internal costs. VOO only changes holdings when the index committee updates the list, which happens infrequently compared to active trading. Every time an active manager buys or sells, they lose a tiny fraction of value to the bid-ask spread. Over thousands of trades, these fractions add up to significant performance drag. Active mutual funds must keep cash on hand to handle investor redemptions. This cash earns almost nothing and drags down performance during bull markets. VOO remains almost fully invested. While VOO tracks American companies, these firms generate over 40% of their revenue from international markets. You get global growth exposure with American legal and accounting protections. The index automatically adds new innovative giants as they grow. You owned companies like NVIDIA and Tesla as they rose to dominance without having to identify them as winners yourself. When a company fails to meet the criteria of the index, it is removed. This systematic removal of losers prevents a single failing company from dragging down your long-term wealth indefinitely. Many active funds charge front-end or back-end loads, which are basically sales commissions. VOO has no such fees, allowing every dollar you invest to go toward buying shares. Retail active investors are competing against high-frequency trading firms with microwave towers and fiber optic cables. Indexing avoids this high-speed arms race entirely by simply holding long-term. Using a systematic investment plan with an index fund takes less than 5 minutes a month. You save hundreds of hours of research time while achieving better results than most professionals. Risk-adjusted returns are often higher for index funds. Active managers may occasionally see higher returns, but they usually take on significantly higher volatility and risk to achieve them. Equities are a natural hedge against inflation because companies can raise prices as their costs increase. Holding the 500 largest firms ensures your purchasing power is protected over time.
For retirees, a steady index provides the predictable diversification needed for safe withdrawal rates. Avoiding the sharp drop of a failing active fund is critical during the distribution phase of life. Buying VOO every month, regardless of price, uses market volatility to your advantage. You buy more shares when prices are low and fewer when prices are high, automatically lowering your average cost. The greatest benefit of VOO is the psychological piece. You stop checking stock prices every hour and start focusing on your life, knowing your wealth is tied to global progress. Active investors often concentrate in a few stocks to try and beat the market. This creates a risk of total loss if one company fails. VOO spreads that risk across 500 giants. The index rebalances itself without you having to lift a finger or pay a brokerage fee. This maintains the intended risk profile and ensures the portfolio always reflects the current economic reality. Historically, the American stock market has returned about 10% annually over long periods. Betting against this long-term upward trend has been a losing strategy for over 100 years.
Active managers often take safe bets just to keep their jobs, which leads to closet indexing with higher fees. They are more worried about their careers than your actual investment returns. Most stocks actually underperform cash. Only a tiny percentage of superperformers drive all the market gains. By owning VOO, you are guaranteed to own those few superperformers. Staying informed enough to beat the market is a full-time job that requires expensive data terminals and deep expertise. Most retail investors are playing a game they cannot realistically win. In recent years, a small group of tech giants has driven most of the market gains. If an active manager missed just 2 of these stocks, they almost certainly underperformed the index. VOO is incredibly liquid, with billions traded daily. You can enter or exit your position in seconds with virtually no price impact, unlike smaller active funds or individual stocks. Investing in VOO is a commitment to the long-term growth of human productivity. It turns time into your greatest ally, rather than your most stressful enemy.
Low fees plus maximum diversification plus long-term time horizons equals a 99% probability of beating active investors. The math is simple, and the results are proven. Passive investing with the Vanguard S&P 500 exchange-traded fund is the mathematically superior choice for long-term wealth. Stop hunting for needles and buy the haystack. Investing is not about being the smartest person in the room, but about being the most disciplined person in the market. Stick to the index and let time do the work.